Welcome back to Father and Son Investing. You may be aware that the mantra at the Treasury when it comes to selling bills, notes, and bonds is regular and predictable. Regular and predictable until it isn't. Today we're going to talk about that regular and predictability and how that has changed recently. I'm also going to talk to you about Treasury buybacks. Yes, the U.S. Treasury has a buyback program coming to you in 2024. So let's get to it. The Treasury didn't always have the regular and predictable mantra when it came to issuing their debt. In fact, in the 1970s, they frequently caught investors off guard when they, on an ad hoc basis, just issued randomly some debt. They pivoted to the regular and predictable mantra, and according to a 2007 New York Fed paper, that actually helped reduce the market insecurity, and it actually lowered the Treasury's borrowing costs. So regular and predictable is what investors have come to expect from the U.S. Treasury. However, recently that changed. On November 1st, when the Treasury issued their upcoming guidance for the quarter of what they would be borrowing, there were some changes in there. We're going to take a look at a chart in the quarterly refunding statement issued on November 1st by the Treasury Department. And what you'll see here is that the coupons were issued at a higher rate at the lower end of the spectrum here. The 2-year and 7-year coupon issuance was going up. You can see the difference between August and January going up. And the ones at the longer end of the spectrum, the 10-year, 20-year, and 30-year maturities, those were not going up or going down actually. By the end of January, you'll see that the total issuance had gone down. Now this was a change here from the previous quarterly refunding statement back in August where everything was just going up. And the thought behind this was, and in fact the Treasury Borrowing Advisory Committee actually made some recommendations regarding this, was that the Treasury should decrease the number of bonds being issued at the 20 and 30-year range and the 10-year Treasury note in order to take some of the pressure really off of those rising bond yields at the higher end. Thus, they would be shifting things towards the lower end and also would have to issue more Treasury bills. In fact, it's going to go above that recommended 15 to 20% that the Treasury Borrowing Advisory Committee usually recommends. So this was a change different than the regular and predictable here. In fact, I'm going to show you a recent quote from Janet Yellen that's in the Wall Street Journal, and then I want to show you a talk that was just issued today, November 16th, by one of the Treasury undersecretaries. This is from the Wall Street Journal, November 16th. Wall Street loves Washington's new debt approach for now, and they quote Secretary Yellen saying, "Our quarterly refunding, I think, did show some flexibility with respect to issuance. That seems to have had a favorable impact." A favorable impact on what? On bond prices. In fact, this graph in the same article in the Wall Street Journal shows just how much bond prices slid after that November 1st announcement where they decreased the number of notes and bonds on that long end of the spectrum. Look at how quickly things just plummeted on November 1st. What does this do to that regular and predictable mantra, and what sort of signal does this send to the market? I think, number one, it's going to start to make things less regular and predictable if the Treasury is going to be shifting things around like this. Now, this is part of their game plan. I'll show you here in just a minute the talk from one of the undersecretaries that I mentioned. I think one has to ask themselves, though, is this really what the Treasury wants? Do they want to now be succumbing to the wishes of the market when bond yields are not what they want them to be or bond prices what they want them to be? In fact, there's a quote here in this article from a head of the U.S. rate strategy at TD Securities where they say, "The Treasury aims to never be the subject of conversation when it comes to issuance. And unfortunately, the background is such that they are the number one subject of conversation in current markets." Now let's get to that speech that I mentioned by one of the undersecretaries at the Treasury. These are remarks by Undersecretary for Domestic Finance, Nellie Liang, at the 2023 Treasury Market Conference. This speech was given today, November 16th. She goes on in this speech to highlight some possible reasons why bond yields had risen so sharply. There are a number of those in the Treasury Borrow Advising Committee report to Secretary Yellen on October 31st. Then she says in here, finally, at the most recent quarterly refunding, amid elevated volatility, keep that in mind, elevated volatility, the Treasury is paying attention to volatility here, we decided to moderate the rate of increase in longer dated coupon auction sizes, an action which was broadly aligned with the expectations of the primary dealers. However, I've read in a different article that the primary dealers were actually a little bit surprised that they did this, but that's neither here nor there. She goes on to say, as always, we strive to finance the government at the least cost over time, and our borrowing decisions are made within the context of our regular and predictable issuance framework. Now they've incorporated this into their framework. This framework considers a range of factors, including an assessment of demand points across the curve. You can go ahead and read into that. We'll pay attention to what bond yields are and what investors are screaming about and try to adjust things accordingly. Near the end of her speech, she actually starts talking about Treasury buybacks. Now, this is not new information. They actually announced their intent or anticipation of doing this in May of 2023 for 2024. Back in September, there was a speech that was given on September 21st, 2023 by Assistant Secretary for Financial Markets, Josh Frost. He's actually the same person who issues these Treasury announcements when it comes to the quarterly refunding. This is a very interesting speech to read through where he kind of highlights what the intent is of these Treasury buybacks that will be coming in 2024. In that speech, he goes ahead and gives some history of Treasury buybacks. He talks about the Treasury instituting that kind of at the end of the 90s when they were actually in, surprisingly enough, a budget surplus here in gray, prior to that running budget deficits, but at a much smaller pace than what they're currently doing. So back when they were actually having some budget surpluses, they started to decrease the amount of certain bonds that they were issuing, and that really caused some kinks in the system when it came to liquidity and that regular and predictable sort of mantra. So one of the things that they started doing was buying back some of these US Treasuries from people and thus keeping some liquidity going in the market. But he also emphasizes that when we had the end of surpluses and started running deficits again, the Treasury stopped that buyback program, which is kind of unique when you think about the kind of deficits we're running now and instituting a buyback program. So let's just look at this buyback program again from his speech. He emphasizes that they have two objectives for their upcoming buyback program. The first is liquidity support. I kind of just described some of that when it came to the previous buyback program. And cash management. What sort of cash on hand does the Treasury have? He does say that they intend to do this as a regular and predictable thing. He says, we do not intend to conduct tactical or ad hoc operations. So they're trying to stick to that regular and predictable mantra. I want to look here at this paragraph where he says, regarding liquidity support, he says, we believe that buybacks will help improve liquidity of the Treasury market by providing regular opportunity for market participants to sell back off-the-run securities across the yield curve. Read into this that they're going to give entities the capability to sell back to the Treasury marketable securities that they're otherwise unable to unload, or unable to unload at a price or a haircut, the amount that they're going to lose, that they're unwilling to take. I want to highlight this paragraph in his speech. It's regarding liquidity support here. And he says, we believe buybacks can help improve liquidity of the Treasury market by providing a regular opportunity for market participants to sell back Treasury off-the-run securities across the yield curve. What does that mean? Read into this a potential government bailout here of how the Treasury will buy back securities that large entities are otherwise unable to unload, or they're not willing to unload at a cost to them that they find unacceptable, because a lot of these older Treasury notes, bills, and bonds, of course, aren't yielding much. Now, as I read this sounded to me like the Treasury was doing something that didn't make sense. They're going to buy back bills, notes, and bonds that have lower yields on them, meaning lower cost to the government, and instead we'll need to reissue bills, notes, and bonds that at the current rates would be higher interest rate to the government, higher cost to the Treasury. So he tries to address that a little bit in here. He says, we think it would be imprudent to try to replace the interest rate risk that buybacks remove from a certain maturity sector in the market by precisely offsetting them with issuance of an equivalent amount of on-the-run Treasury securities in the same maturity sector. Exactly what I just said. He said that would be imprudent, and it would be. He said attempts to do so unnecessarily would limit the flexibility of our issuance strategy and run counter to regular and predictable issuance. But then he introduces that same bit of not regular and predictable where he says, when evaluating how buybacks affect our issuance plans, we will continue to look at our borrowing needs in totality in short, intermediate, and long term and make issuance adjustments based on what we believe is the appropriate mix. So I hope I've given you two topics today that intrigue you and will make you think more about this and perhaps delve into this a little bit more. Regular and predictable, what will be the effect when it's not regular and predictable anymore, when the Treasury starts bowing to the markets and starts looking at the different bills, notes, and bonds and trying to adjust them to keep bond yields down. I know that sounds like it makes sense, but when it is no longer regular and predictable, perhaps then borrowers will expect an increased yield because it becomes not regular and predictable. Something to think about. And then number two, that buyback program. To me, it sounds a little bit like a bailout here, a disguised bailout where they're giving certain large entities the ability to essentially sell back to the Treasury the stuff that they can't otherwise move in order to keep those guys buying U.S. Treasuries. If any of this was useful for you, please give us a thumbs up and hit that subscribe button. And as always, until next time, enjoy your investing.